Well, hello. It's October 23rd, Wednesday. Today was a big day. The Bank of Canada, did they surprise us or not? I guess we're joined here with Josh. He's going to give us some more information, but today was the rate announcement day. We share these videos every week with you. This is a special video that we're releasing to talk about the rate announcement. If you find this information valuable, do us a favor. Like it, subscribe, and we're going to share some more good content with you down the road. But for now, Josh, thanks for joining us. He's with Mortgages for Less. Tell me what's going on here. What happened today?
Well, today we had the Bank of Canada rate announcement, like you said, and it came in big. It came in at 0.5% rate drop. Last time we saw something like that was when COVID first hit. They were emergency measures to do that 0.5% rate drop. The time before the COVID ones was like back in 2008 when the subprime mortgage collapse in the US happened. So the 0.5% rate drops really only happen in almost like emergency or unusual type situations. And I guess it looks like we're in an unusual, almost emergency type situation here again. So we've just had 0.75% drop since June, and now a 0.5% rate drop. And there's a high probability of more coming here soon.
So just to reiterate, we've had 3 drops since June up till now, 0.25% each. Today we had 0.5%, and you're going to let us know, is it actually,
that's right.
Are we in trouble here or what's going on?
It's a 1.25% rate drop so far. We'll likely see another 0.5% rate drop this year and a few more 0.25% drops into the new year. So are we in trouble? Maybe, right? One of the reasons in the interest rates were going up in the first place is that a couple of years ago, partway into COVID, when the interest rates were really, really low, supply chains around the world were constrained. We saw the prices of everything go up. Food prices were increasing at more than 10% a year. The only thing that seems to have not increased in price is the banana. It's reliably at 70 cents a pound or something like that. Everything else has gone up significantly. And the most recent inflation reading came in for September at 1.6%. So it's not at zero, and we don't want to see it at zero. The bank wants to see it at about 2%. 2% inflation, by their estimation, provides price stability for Canadians.
So just to clarify, 1.6 is the rate of change from September 2024 to September 2023?
That's exactly it. So prices, of course, are still up. They're just not up as much as they have been. In previous months, it was up by 3%, 4%. And of course, 2 years ago, up by 8% from the year before, right? So, those compound year over year. So no, things aren't cheaper. Maybe they are if we look at the consumer price index, which is, there's a typical basket of goods. What does that cost? Well, the index for that's 161 right now. 4.5 years ago, it was 130. So from there, we've seen a massive increase because we had that high inflation number for a couple of years, right? So prices today are almost 18% higher on average than what they were 4.5, almost 5 years ago before COVID hit.
So this gives us a lot of insight here, because it would feel like when you're hearing these reports and they're talking about this concern, and it's like it's not any cheaper to get through the month over month. And so the reality of it is that this is just a measurement, or I guess depending on the term you're using or the time you're using to measure it. So really, just because we're seeing these alarming numbers doesn't mean it's going to be cheaper for us month to month or day to day.
That's right. And we're not really expecting it to be cheaper. If we look at the curve up here at the top, you do see from a couple months ago to now, it's gone down just a little bit. And that's happened in little small periods along the way, month over month. But a lot of that actually is just the price of oil, right? Gas is cheaper than it was in the summer months by 10, 15, 20 cents a liter, right? So there are changes like that will have an impact. Certain things like certain fruits or vegetables are going to cost less in the summer than they do in the winter. So things do change in price on a month-to-month basis. But kind of that overall trend, we're still up 18 or so percent from 4.5, almost 5 years ago. It's not like that's going to reverse. What needs to happen is wages and our incomes need to adjust. We've seen wage increases as well, but not enough to keep up with this, which is why it still feels like everything's so expensive.
So what's interesting to me is this data is related to Canada as a whole, right? On a federal, this is what we're talking about.
Right. And the typical cost of goods.
Right. So what does this mean for us, though? Is this really relative to us here in Edmonton, here in Alberta? What's the scoop with that?
It means as our wages sort of catch up to some of this increase, we're not going to have prices of things continue to run away from us.
Okay.
Some things like cars might be a bit less than they were last year, right?
Right.
But gas might be a little bit cheaper. But of course, in Alberta, we like it when gas is expensive because that means the price of oil is high. It means more employment in Alberta. So we could look at it nationally, yes, but for sure, Alberta matters. Now, the economy, that's measured as gross domestic product, and it's measured by growth. We've all heard about recessions, the big R word that we don't want. The definition of recession is GDP growth being under zero. So GDP shrinkage, I guess, for 2 quarters in a row. The bank was forecasting an increase in the GDP, so the increase in the growth of our economy, to go up to 2.8% in the third quarter from 2.4 in the second quarter. Those numbers don't really mean anything to us individually other than it's bigger, and that's good. We want a growing economy, but those revisions have been changed. They're now going to be a lot lower.
It's just not growing as fast as we hope. So hopefully we can get something happening where our GDP increases at a greater level, which will help us more money. So
that's absolutely it.
Yeah. Okay. So now we're homeowners. What did the 0.5% mean to us today? Like, what does that mean for, do I get more money in my jeans?
It doesn't really mean too much. If you have a variable rate mortgage and it's with one of the lenders, most of which, except for a few banks, most of the mortgage lenders, if you're on a variable rate, your payments change whenever the rate changes. Okay. So if you're in that type of variable rate mortgage, for every $100,000 that you've borrowed, assuming a 25-year amortization, so your exact results will vary, but it's close to $30 a month per $100,000. So if you've got, say, a $400,000 mortgage, which is pretty typical, it's going to be close to $120 a month less for your mortgage payment. So that is more cash in your jeans or more available left on your debit card at the end of each month. Now, if you're looking to purchase a home, this brings the interest rates on variable rate mortgages down closer to 5% instead of the 5.5% where it's been, and over 6% not that long ago. So if you want to get a variable rate mortgage, it will make it easier to qualify because the interest rate on it's now lower, but it's still a higher rate by about 1% than our lowest 5-year fixed rates. So 5-year fixed rates, they're influenced in other ways. They are not really going down today. We're not expecting them to go down today as a result of this. So if you have a pre-approval on a fixed rate, that's not changed.
Gotcha.
If your mortgage is coming up for renewal, maybe the variable rate is something to actually consider now that we're in that downward trend and the differential in the rates isn't as big as it was. So it could be that going variable is better than a 3 or a 5-year fix, but that's something where, we got to look at your situation, understand what your individual finances look like, see what you can handle if things go as planned, or what if they don't go as planned, right? It's different for everybody.
Yeah. So thanks for that insight, Josh. That was super helpful. Obviously, if you are coming up for a renewal or you are looking for a mortgage, there's different things that we need to use, or Josh needs to use to measure which product is right for you. Send us an email, leave us a comment in the text below here, and we'll respond to you. If you need to speak with me, you can call me, text me. Make sure if you send me a text, you tell me you see me on YouTube, or I'll think it's a scammer, of course. But anyway, call, text me, and I can help you with your real estate related questions. But for now, that's all we got for you. Thank you for joining us. Please like, subscribe, leave us a comment. We can't wait to see you again next week.
Thank you.